Okay, let's dive right into what has become a massive compliance challenge for pretty much any company with a modern distributed workforce. For years, state taxation was pretty simple. It was all anchored to one idea: physical presence. But with the explosion of remote work, that anchor has come completely loose. And what we have now is this huge disconnect between where work actually gets done and where it gets taxed.
So you have to ask yourself, is that Form W-2 your company issues just a simple tax summary anymore, or has it turned into a legal minefield? For any business with remote employees, this once routine annual form has suddenly become a high-stakes document where these intense jurisdictional battles between states are being fought. Seriously, what used to be a straightforward summary of earnings is now a complex legal declaration, and it has major consequences for both the company and the employee.
So in this explainer, we're going to break it all down. First, we'll uncover the hidden landmine just waiting for you on the W-2. Then we're going to get into the jurisdictional tug-of-war that's really driving all this chaos. We'll do a technical deep dive into boxes 15 through 17, and then we'll look at the painful result: double taxation. And finally, we'll explore how you can navigate this mess and, what the future might hold.
First up, let's be really clear about what this problem is. This is not just some minor payroll headache. No, we're talking about a fundamental, structural conflict in the U.S. tax system, and it is catching millions of remote workers and their employers right in the crossfire.
We're calling it the telecommuter's tax trap, and it's created by this clash between two totally competing legal ideas for how to tax income. On one side, you've got the state where an employee actually lives and physically does their work. But on the other side, you have the state where their employer's office is located, and that state might also claim the right to tax that income, even if the employee never ever sets foot there.
So let's get right to the heart of it. This entire mess, it all boils down to two completely different and, frankly, conflicting standards that states are using to claim the authority to tax someone's income. Most states follow what's called the physical presence standard. It's logical, right? It makes sense. You pay tax where you physically do the work. Simple. But then a handful of states use this much more aggressive rule called the convenience of the employer rule. And this rule says that if you work from your home in, let's say, New Jersey for your own convenience, but your company's office is in New York, well, New York can still tax 100% of your income, just as if you got on the train and commuted in every single day.
So which states are we talking about here? Well, New York is definitely the most famous one, but as you can see, Arkansas, Delaware, Nebraska, and Pennsylvania are also in this club. And then you have Connecticut, which has this unique retaliatory rule. They only apply the convenience rule to residents of other convenience rules states. It creates this incredibly complicated web of if-then scenarios that payroll departments have to untangle. It's a mess.
Okay, now let's get into the technical details, because this is where the rubber really meets the road. This whole abstract legal fight plays out in three tiny little boxes on your Form W-2. Boxes 15, 16, and 17. This is where the legal theory becomes a high-stakes numerical reality. Let's start with box 15. It looks so simple, it's just the employer's state ID number. But legally, it's a huge deal. It's a formal declaration. By putting a state's ID number in that box, a company is officially admitting that it has a business connection, what's called a nexus, in that state. And that one single entry can trigger this whole cascade of obligations for state unemployment insurance, for workers' comp, and even for corporate income taxes. It is absolutely the first domino to fall. Now, box 16, this is the main event. This is the sourcing battleground. It's where the state sourcing rule directly hits the numbers. And this is where you see that notorious New York 100% reporting quirk. New York tax law literally requires that if an employee has any New York-sourced income, box 16 must report their entire federal wage from box 1. Just think about that. An employee could work 1 week in New York and 51 weeks in Florida, and box 16 for New York will still show 100% of their annual salary. It's wild. And finally, we have box 17. This shows the actual tax that was withheld for that state. The accuracy of this box is absolutely critical for the employee. I mean, this is the number they're going to use to claim a credit for taxes paid to other states on their home state tax return. It's their only mechanism to avoid being taxed twice on the exact same dollar. When you lay it all out like this, you can see a really clear landscape of risk for the employer. Mess up box 15, and you have a high risk of creating a broad tax nexus you didn't want. Mess up box 17, and you could trigger immediate automated notices from state tax departments because the withholding doesn't match the wages in box 16. You see, managing these three little boxes has become a critical risk management function. Okay, let's shift gears and talk about the direct financial hit on the employee when these rules collide. This is where the trap really, truly springs shut. So let's paint a picture. Imagine you have an employee who lives and works from home in Pennsylvania. It's a state with a relatively low, flat income tax rate of just 3.07%. Now, let's say their employer is based in New York, a convenience rule state with a much higher marginal tax rate, something like 6.85%. Because that employee is working from home for their own convenience, New York is going to come in and tax their entire income at its much higher rate. And here is the trap. When that employee goes to file their Pennsylvania tax return, Pennsylvania will give them a credit for the taxes they paid to New York. But, and this is a huge but, that credit is capped at Pennsylvania's own lower rate of 3.07%. So what does that mean? It means the employee is personally on the hook for the difference. That's a direct, out-of-pocket financial loss every single year. But believe it or not, it can get even worse. The absolute most severe trap happens when the employee's home state denies the credit entirely. States like Maryland or California might look at the situation and argue, hey, the work was physically done inside our borders, so that income was sourced to us. They don't recognize the legitimacy of New York's convenience rule at all, so they just refuse to grant a credit for the tax paid to New York. And the result for the employee is catastrophic. They end up paying full state income tax to both states on the exact same income.
So, given these really significant risks, employers just cannot afford to be reactive. You have to be proactive. Let's talk about a rigorous compliance process and some of the strategic corporate responses that can help mitigate this trap.
So how do you fight back? Well, it really requires a proactive, documented process. Step 1 is you have to track. You absolutely must know where your people are physically working, day by day. Step 2, you have to apply the rules correctly and determine the right state of assignment for every single employee. Step 3 is withholding. In some of these complex cases, the safest path might actually be to do split withholding for both states to cover your bases. And finally, step 4, and this is so important, document everything. Clear records justifying every single sourcing decision are your only real defense in an audit.
And beyond just the technical compliance, a lot of companies are making major strategic shifts. We're seeing many abandon those work-from-anywhere policies and instead creating approved hubs in more tax-friendly states to limit their Nexus footprint. Some are even taking the drastic step of closing their physical offices in convenience rule states like New York. Because think about it, if there's no New York office, the convenience rule can't apply. And the last resort, of course, is offering employees a tax gross-up to make them whole, but that's a direct hit to your company's bottom line.
All right, finally, let's zoom out and look at the bigger picture here. This problem is so significant now that it's gotten the attention of the courts and Congress. But so far, there's no clear resolution in sight.
The path forward is really uncertain. The Supreme Court had a golden opportunity to provide some clarity in the New Hampshire versus Massachusetts case, which directly challenged a convenience-style rule, but they declined to hear it. At the federal level, there have been multiple attempts to pass something called the Telecommuter Tax Fairness Act, which would basically force a physical presence standard nationwide. But so far, that legislation is stalled.
And this brings us to what I think is a really critical perspective shift. You have to start treating the W-2 not as some static end-of-year report, but as a dynamic legal defense of a person's jurisdictional status. It is no longer just about summarizing taxes. It's about building a legal document that is prepared to withstand some serious scrutiny.
So the big question is, with no federal solution on the horizon, is rigorous, careful W-2 reconciliation your only defense? For now, the answer is a resounding yes. Until the Supreme Court decides to step in, or Congress finally acts, this battle is going to be fought company by company and employee by employee, right there in those tiny little boxes on the Form W-2. Mastering these details isn't just good compliance anymore. It is the only way to navigate the telecommuter's tax trap.